Welcome to Talk Tickers. We're your shortcut to understanding what's really happening behind the numbers in corporate earnings.
And today, we're digging into the Liberty Energy third quarter 2025 earnings call. This one was from October 17th.
Our goal here is pretty straightforward. Cut through the jargon, get you the core financials, the big strategic moves, and what they're signaling for the future.
And this call, wow, it was something. Because the headline numbers, well, they mostly missed what Wall Street was expecting.
Right, missed the mark. But the market, it reacted like incredibly positively. Huge jump in the stock.
Exactly. So you've got this really interesting split signal. It's a narrative shift. You know, the market seems to be looking past the immediate bumps.
Totally. It feels like the story here is about this major pivot they're making, betting big on something new, even while their main business faces, well, some headwinds.
Let's start with those headline numbers just to ground ourselves. Revenue for Q3 came in at $947 million.
Which sounds like a lot, but context matters. That was down, 9% sequentially? And it missed the consensus estimates.
Yeah, missed the mark there. And adjusted earnings per share, that actually landed in the red, a loss of 6 cents per share.
Oof. And the street was expecting like a penny loss. So definitely softer than anticipated on the upside.
Operationally, yes, it was soft, but, and this is where it gets interesting, the GAAP EPS, the official accounting number, printed positive $0.26 per share.
Okay, how does that happen? A loss unadjusted, a profit on GAAP?
Well, it was mostly driven by a big non-cash gain, about $53 million tax affected from some investments they hold.
Ah, okay. So not from selling more services or better pricing.
Yeah.
But it does maybe show some financial flexibility.
Exactly. It signals they have levers to pull, resources maybe, and it let them project confidence, which they definitely did.
Yeah, they did. Because the thing that really grabbed attention despite those misses was the dividend announcement.
Big one. They raised the quarterly cash dividend by 13%, up to 9 cents a quarter, starting in Q4.
That's a pretty bold move when your adjusted EPS is negative. It's basically management saying, look, we see the current softness, but our cash flow is solid. This is temporary.
Right. And they backed that up operationally, too. Even with the slowdown, they hit quarterly records for pumping efficiency and total sand tons sold.
So execution is still top-notch, even if the market's a bit tougher.
That's the message. Best-in-class execution, even in a down part of the cycle.
Okay, let's unpack that core business then, the frac side. They were pretty upfront about the near-term challenges, right?
Oh, very candid. They said industry completions activity, drilling and completing wells, has slowed down quite a bit.
Slowing down how much?
Significantly. They actually stated it's fallen below the level needed just to sustain current North American oil production.
Wow, okay. So activity isn't even enough to replace the natural decline of existing wells.
Pretty much. And that moderation, plus the usual Q4 seasonal slowdown, means pricing pressure. Especially, they noted, for the older conventional frac fleets out there.
So if activity's down and pricing's tight, how are they feeling confident enough to raise the dividend and talk about this huge new venture? Where's the cash resilience coming from?
Yeah, that's the million-dollar question, or maybe billion-dollar, given the pivot. Their answer boils down to one word: technology.
Technology as a shield against the cycle.
Kind of. They're leaning heavily on their proprietary gear and software to keep their own engines healthy, even if the overall market is weak. It's about efficiency.
Okay, talk us through that. What's the hardware advantage?
Starts with their digiPrime fleets. That's their next-gen electric hybrid pump tech. And the numbers they're seeing are impressive.
Like what?
Well, they mentioned total maintenance cost savings are running greater than 30% compared to older equipment. That's huge.
30% lower maintenance.
Yeah.
When jobs are scarcer, keeping your costs down is critical. That's a real moat.
Absolutely. And then they layer software on top of that. They talked a lot about Stim Commander.
That's the AI thing that runs the pumps.
Sort of, yeah. It's AI-driven software that handles the rate and pressure control automatically during the frac stage. It makes execution faster and way more consistent.
Faster how?
They quoted numbers like a 65% improvement in the time it takes to hit the target fluid injection rate, plus like a 5 to 10% boost in hydraulic efficiency.
So shaving minutes off every single stage.
Exactly. And across thousands of stages a year, those minutes add up fast. Saves the customer money, lets Liberty get more work done with the same fleet.
And the system tying all this together, they called it Forge. Management seemed keen to explain it wasn't just like ChatGPT for fracking.
Yeah, they made that distinction very clear. Forge isn't some static large language model. They described it as a distributed agentic intelligence system.
Okay, translate that.
Yeah. Think of it less like a chatbot and more like a specialized brain for the whole operation spread across the equipment. It's constantly planning, learning from real-time field data, acting, and then adapting.
So it's modeling everything.
Pretty much. Every pump, every sensor, every interaction, it's trying to optimize the whole fleet, turning all that operational data into like predictive actions. Helps them run leaner too, fewer people needed on site potentially.
Okay, so the frac business is using tech to navigate the downturn. But the big story, the one driving the stock, is applying that same kind of tech thinking to a whole new area, power generation, Liberty Power Innovations, or LPI.
Yes, LPI. This is clearly where the market's excitement is focused. Management laid out some ambitious targets here.
Oh, ambitious.
They're aiming for total power generation capacity to go over 1 gigawatt delivered through 2027.
1 gigawatt, that's a lot of power, like utility scale.
It is, and just for context, they expect to have roughly half of that, about 500 megawatts, delivered by the end of 2026 alone. So rapid scale up.
And who needs all this power? What's driving the demand?
It's structural demand, stuff the traditional grid is frankly struggling with. They pointed right at the massive power needs of AI compute data centers.
The AI boom connection.
Definitely. Plus broader electrification trends, EVs, heat pumps, and also industrial reshoring factories coming back that need reliable power. These are big, sophisticated users.
And they need power that's flexible, reliable, maybe not always available from the main grid.
That's the pitch. Grid constraints, grid volatility. These customers need guaranteed power, often on-site or nearby, and Liberty thinks they can provide it better, faster, more reliably.
And it sounds like the data center customers, the hyperscalers, are really biting.
Oh, yeah. Management said they expect a, quote, higher percentage of their capacity will ultimately serve data centers.
And get this, their sales pipeline for that specific segment more than doubled in just the last 90 days.
Doubled in 90 days. Wow. The AI demand is real.
It seems so. It's literally fueling their order book for this new power business.
Okay, but building a gigawatt, even half a gigawatt by 2026? That takes serious capital, billions, potentially. How are they funding this without crushing their balance sheet, especially with the frac market being soft? This is where the financial engineering or maybe strategic structuring comes in. It's actually quite clever how they're planning it.
How so?
All right, first, the contracts they're signing are very long-term, typically 15 years or even more. Think infrastructure-like agreements.
15 years. Okay, that provides visibility.
Huge visibility. Then, for the big projects, especially these data center deals, they're setting up separate project companies to hold the assets, the generators.
Like subsidiaries.
Exactly. And the key part is how they finance those subsidiaries. They estimate about 70% of the capital needed will come from project-specific, non-recourse debt.
Non-recourse. Explain why that's so important.
Non-recourse means the debt is tied only to that specific project. If, worst case, the project fails, the lenders can only go after the assets within that project company.
They can't come after the parent company, Liberty and Energy itself.
Correct. It protects Liberty's main balance sheet. And the reason banks are willing to provide this non-recourse debt is because it's backed by those super long-term energy service agreements, the ESAs.
So the 15-year contract with the data center basically acts as the collateral for the loan.
Precisely. Many of these are likely take or pay contracts, meaning the customer pays whether they use the power or not, guaranteeing revenue. And these customers, the hyperscalers, are often investment-grade credit quality.
So it turns a potentially volatile energy project into something that looks much more like a stable, predictable infrastructure asset from the bank's perspective.
I got it. Bond-like risk profile, almost.
Okay, makes sense. But what kind of returns are they targeting for locking up capital for 15 plus years, even if it's secure?
Management said the target unlevered cash return is in the high teens.
High teens, that's quite good for something structured to be relatively low risk.
It is. You're getting equity-like returns for something secured almost like debt, thanks to the contract structure and customer quality. Now, because the contracts are so long, the actual payback period for the initial investment is longer, maybe 5 years or more, but the cash flow stream is expected to be very stable and predictable.
All right, let's switch to the actual tech they're deploying. What kind of generators are we talking about?
The workhorse, the core technology, is gas reciprocating engines. Recips, they called them.
Like big natural gas-powered engines. Why those specifically?
Efficiency. They favor them over, say, simple cycle gas turbines because the recips have a superior heat rate. They're achieving around 45% thermal efficiency.
And why is 45% the magic number?
It means they're getting more electricity out for the amount of natural gas they burn. lower fuel cost per megawatt hour generated. In a competitive bid for a 15-year power contract, that efficiency edge lets them potentially underbid competitors, but still hit their own high teens return targets.
So the same obsession with efficiency from the frac side carries over directly to the power business economics.
Exactly. It's the common thread. Now, turbines aren't totally out of the picture. They might use them where power density, getting a lot of power in a small footprint, is really critical.
And they mentioned some future tech, too.
Yeah, looking further out, they highlighted their ongoing collaboration on small modular nuclear reactors, SMRs, through their Oklo partnership. That's more like a decade-plus kind of thing.
Okay. And what about emissions, especially near cities or sensitive areas?
Good point. They specifically mentioned using fuel cells, likely in combination with the recips, to meet strict emissions limits in what are called non-attainment areas, places with existing air quality challenges. So they have a compliance toolkit, too.
Got it. And how quickly can they actually get these things up and running? Deployment timelines?
Seems pretty fast, actually. For the standard recip packages, they said it takes about 6 months from delivery to generating revenue.
6 months. That's quick.
Yeah. For the really big units, the 10, 12 megawatt RCIPs that go into permanent power buildings, it's a bit longer, maybe up to 9 months start to finish. Still quite rapid for building significant power capacity.
Okay, let's zoom back out. Investor context. This all points to a major shift in where they're putting their money, right? Capital allocation.
Absolutely unmistakable shift. The frac business, while still crucial for generating cash today, is seeing its capital budget moderate significantly.
They said 2026 spending is markedly shifting towards LPI.
Yep. And the base case plan for 2026, no new frac fleet builds at all. They're taking cash from the efficient but cyclical core business and plowing it into this non-cyclical, long-term growth engine in power. Strategic recycling of capital.
And their view on that core frac market improving.
They see the current softness as temporary, cyclical. They expect things to get better in 2026.
Based on what?
Two main things. First, they think the global oil oversupply situation will peak sometime in the first half of 2026. Second, they see natural gas fundamentals strengthening, thanks to all the new LNG export terminals coming online and rising domestic power demand, partly driven by AI, ironically.
Interesting loop there. And we should probably mention the CEO's closing comments. He had some strong words about government policy.
Yeah, he definitely did. He specifically called out tariffs on steel, aluminum, and critical AI hardware components.
Saying, what about them?
Basically arguing they just raise costs, hurt productivity, and ultimately put the U.S. on a, quote, path to mediocrity instead of dominance in energy and AI. He framed them as counterproductive to national goals.
So connecting those tariffs directly to their own costs and competitiveness, it adds another layer to why their internal focus on efficiency is so relentless.
Exactly. It's not just a business strategy. It's presented partly as a way to overcome policy-driven cost headwinds, a necessary countermeasure.
Okay, fascinating stuff. Now, let's switch gears to our final segment. This is not financial advice. We look for an outrageous but maybe plausible trade idea based on what we've just heard.
And given this massive divergence, weak near-term frac numbers, huge positive reaction to the long-term LPI story, a paired trade seems like the most direct way to play it.
Okay, lay it out. What's the idea?
Well, the core concept is simple. You go long Liberty Energy, you're betting on the execution of that 1 gigawatt power plan, which looks pretty well de-risked with those long-term take-or-pay contracts from solid customers like data centers. Secure cash flows.
So, long Liberty based on the LPI story and the market's reaction. What's the other side of the pair? The short.
Right. You pair the long Liberty position with a short on something exposed to the opposite trends. Maybe a pure play frac company that doesn't have Liberty's tech edge, one that's much more exposed to the near-term cyclical pricing pressure on conventional fleets.
Or any other ideas for the short?
Or perhaps think about a traditional utility company, maybe one that's heavily reliant on the old constrained grid infrastructure and is struggling to supply reliable power to these booming sectors like AI compute, especially if they carry a lot of debt.
So the bet is basically that the market keeps rewarding the shift towards stable, efficient, decentralized power infrastructure,
while continuing to penalize companies stuck in the old cyclical patterns or tied to the limitations of the legacy grid. It's a bet on structural change winning out over near-term noise.
The ultimate divergence trade, as you say,
Yeah.
Pitting that resilient, contracted power against the vulnerability of older systems.
Precisely.
So wrapping this up, the key takeaway from this Liberty deep dive is pretty clear, isn't it? Despite those headline misses on Q3 operations.
Yeah, the market looked right past them. It fully embraced the long-term growth story, the optionality from this massive LPI build-out, all underpinned by their proprietary efficiency tech.
Which leaves us with a final, maybe provocative thought for you, the listener, to chew on.
Given that so much of this future power demand, especially from AI compute, requires unprecedented levels of reliability and scale, what does Liberty's rapid, successful pivot to providing long-term on-site dedicated power imply?
What does it say about the perceived long-term reliability, or maybe the viability, of relying solely on the traditional utility grid infrastructure, especially for the fastest-growing, most demanding parts of the economy?
It's a big question about the future of energy and computing infrastructure. Something to think about.
Definitely something to think about. Thanks for joining us on Talk Tickers for this deep dive into Liberty Energy's Q3 2025 call.
We'll catch you on the next one.